Hi, my name is Nicholas Anderson. I'm presenting my engineering honors capstone for 2022. For this, I did an analysis of social media-driven meme stocks. I worked with Alexander Danes doing his cognitive science honors. He's not able to present with me. And we were both advised by Professor Daniel Romero of the School of Information. There we go. Cool. So our motivation was mostly around the really high profile events around January of 2021, when a lot of Wall Street Bets users created this narrative of a short squeeze around GameStop, which a lot of institutional investors pushed back on. And there was a pretty big controversy that's deserves its own. I mean, there's a ton of independent research projects that would go a lot more in depth than I can in this video, but basically we wanted to see if there actually was a relationship between Wall Street Bets activity and then the price or movement of GameStop. I'm sorry, there's a little ambulance. So another part of our motivation was a really interesting Barclays report around 2021 September, I think. But basically they looked at the price of, or the activity of US options versus European options. And one thing to note is that around the end of 2019, a bunch of retail brokers made it available for individual smaller buyers to buy options without, or in lower volumes than ever before, and also without any commissions. So this Barclays hypothesizes drove up this, and there's another one. This Barclays hypothesizes drove up the amount of stock options activity and a lot of really risky bettors, or really risky investors buying these small quantities of these really risky options, whereas before options are primarily like an institutional thing. And you can kind of see this because brokers didn't make European options available. And if you look on the right, you can see European options, stocks and index options track about each other. But on the left, you can see stock has this huge spike at the end or mid 2020, which doesn't follow ETFs and indexes, which you can see pretty much for all of this graph, they're pretty closely correlated. So yeah, we were wondering if you could predict maybe something based on options based on Wall Street Bets activity, because Wall Street Bets is a subreddit with at least a reputation for making really risky trades. The title of the subreddit is Wall Street Bets. So the data we used PushShift API. We got about 1.7 million Reddit posts, and our data, or the time range we looked at, was 2020 through 2021, and I think we got a little bit of 2022 in there. And then we wanted to use r/stocks as like this is a normal, kind of more like reasonable, typical investment advice, just to see if there's like if we could see meme stocks are popular on Wall Street Bets and contrast it to like meme stocks are not popular. So we wanted, or not popular on like normal subreddits or normal investing communities. So that's why we used r/stocks. And you can see in the distributions on the right here of the symbols that they talked about, Wall Street Bets has this extremely concentrated activity. I mean, almost half of their activity is all GameStop. And then AMC is like a quarter of, or not a quarter of all activity, but represents a large portion of all activity on the subreddit. Whereas r/stocks, I'm slurring words, but that's r/stocks is a lot more balanced on it. And they talk about these bigger companies like Microsoft, Apple, Amazon, and then they also do talk about GME and AMC a bit, but it's worth noting that in 2020 and 2021, those are pretty popular in general. So that's not unreasonable that a lot of anyone talking about investments is going to be talking about these symbols because of the massive amount of news attention they got in 2021. The next thing we used the Yahoo Finance API to collect volume, open price, closing price, daily highs, daily lows, and then the adjusted closing price for a variety of different stocks. Adjusted closing price, if you're unaware, accounts for like stock splits and dividends, things that are going to affect the price of a stock, but like if you're doing how well did a stock do, you want to account for like I'm reinvesting my dividends and I'm if I'm getting a stock split, then I have 7 times as many things in it, or depending on how many it splits into. So then here's just a sample graph of what that looks like. We have high in blue and low in orange, and you can see they stay pretty close together. And then volume is almost completely different. And there's a lot, I guess it's steadily decreasing for this stock. And then the next thing we looked at is implied volatility. So for options, one of the main things in the Black-Scholes model, which a lot of people use to price options, is pretty much all based on this factor called implied volatility. And that's basically what we expect the volatility to be in the next some amount of period. For us, we used 30-day periods, and it was pretty hard for us to find implied volatility data, because if you can think, there's so much options data, and it's such a valuable data set to use that a lot of financial institutions are pretty unwilling to share that, and they want to, I think there were a lot of them that were charging like $1,000 a month, so we were unable to get access to things like those, but we were able to get these daily implied volatility over a 30-day period. So that's what we were able to use. We would have liked to get like more fine-grained looks at how options or how implied volatility is changing, but daily 30 days is all right to do some kind of analysis. And you can see here, AMC is one of the kind of meme stocks, and Microsoft is another, much more well-established stock. And you can see that it's kind of cyclic, that it tends to stay the same. And AMC, because it's like a lesser traded, lower market cap, less well-established company, has a lot higher implied volatility throughout the whole time. So our results were pretty interesting. First, we looked at what Wall Street Bets talked about in 2020, and those are all the words on the left, and 2021. And you can see in 2020, a lot of the coronavirus and the volatility, VIX is a popular volatility index, a lot of those things were talked about. You also have Trump and lockdown Trump and poll from the election. And then you also have on the right, a lot more of these short squeeze terms, like you have shorted, short squeeze, GameStop, ladder, FINRA, and illegal were all part of this kind of narrative on Wall Street Bets, but that's a different topic. So we're able to validate that they were talking about these stocks a lot more. Then for other results, we plotted the activity on Wall Street Bets against the adjusted closing price of these. And you can see that on the day that there was a huge spike in around January, the end of January, that correspondingly, there was a huge change in AMC and GME prices. But for like normal stocks that were more popular on r/stocks, like Apple and Microsoft, those did not feel anything. We also looked at the implied volatility, which that seemed to be a lot better. As you can see, like the further lags out in towards like the April 2021 and August 2021, you can see those follow a lot better. And that kind of makes sense that if Wall Street Bets is talking about it, it's probably moving in some direction. And you could probably predict whether it's going to continue to move based on whether people are continue to be interested on it, if they're actually having an effect on it. So this graph seems to show, granted, most of it's dominated by that single spike at the end of January 2021, but it seems to show, even with the lagging spikes, that there's some correlation between these meme stocks. Also, it's worth noting in 2020, it doesn't appear to be correlated at all with, or at least more correlated with GME and AMC than it is with Microsoft and Apple. So that also validates that this is a relatively new thing. So we tried to fit a model to this. We looked at what the change in price was from the end of that day to the end of the next day, and then see if we could predict that based on the number of posts that day. This is a really wide-grained approach to it, and for financial data, this would be it would be more suspect that we did something wrong if we were able to predict this, because there's so much money involved in this industry trying to predict this that on the order of days, it would be really hard for us to come to a conclusion that we do have a predictive model. And as you can see, what we ended up doing is predicting changes, and then we fit that back to the actual price on the last day. And you can see, even fitting it to the actual price on the previous day and just predicting the next day, that orange line, which is our forecast, is pretty far off. But this is for closing price. We also tried this with implied volatility, and you can see that even though it still is pretty far off, it's a lot better than our adjusted closing price. And we think this suggests that implied volatility, as Barclays found that a lot of retail traders are driving this implied volatility because of the options that they're buying, that it is somewhat more predictable than just the adjusted closing price. So, like I said, we found a lot of interesting trends on r/Wall Street Bets. It's a unique community compared to other online stock communities. We saw that they favored these meme stocks a lot more than other subreddits, and they talked about them in a disproportionate amount by far more. And then we also found that implied volatility seems to be affected by it. But as we expected, where the market is a force that will, like, if it is predictable, someone will find it, and then it won't be predictable anymore. So we were unable to create a predictive model based on that, and that's kind of expected. So yeah, that's our project. And I'd like to say one more thank you to Professor Daniel Romero. He was such a good help in, like, every time we'd hit a problem, he was always there helping us through it. So yeah, that's my capstone video, and thank you for watching.